Hi dear traders, the blackout period starts 2 weeks ahead of the Fed policy meeting, which means that FOMC members will not comment publicly or give any hint about the possible decision. This Tuesday and Wednesday, Jerome Powell will give a closing speech, and in the previous week, comments by other Fed officials were shaping the market sentiment. Let's discuss how different markets reacted to these comments and other drivers last week. The US dollar index, which measures its value against the basket of 6 major currencies, closed last week's session with a decline of 0.59% to end up at 104.53. A sell-off wave in the US dollar resumed in the market after Raphael Bostic, president of the Federal Reserve Bank of Atlanta, supported a 25 basis point rate hike and said that the central bank would halt the tightening process this summer. Other Fed officials displayed a more hawkish stance. For example, Federal Reserve Governor Christopher Waller said he was ready to keep the rate at its peak level until inflation subsides and the labor market cools. On Friday, traders will be looking ahead for the fresh employment report from the US. The robust labor market will help the US dollar regain ground. The euro started this month with a rise against its American rival. February was a bad month for the European currency as it lost 3.8%, posting its worst result since April last year. However, fresh data on inflation in the Eurozone convinced traders that the European Central Bank will continue to raise rates. Besides, comments by the ECB officials supported the euro as well. Thus, ECB President Christine Lagarde said that interest rates would need to rise higher and stay there for some time to bring inflation down. Meanwhile, Bundesbank President Joachim Nagel warned that the central bank might need significant rate hikes beyond March. Another major currency, the British pound, also finished the previous month with losses, yet it managed to open March with gains. Investors cheered the UK's post-Brexit trade deal with the European Union, which is supposed to facilitate trading between Northern Ireland and Great Britain. Markets also expect the Bank of England to take decisive action against high inflation. In the meantime, traders on the Japanese yen are anticipating changes. The Bank of Japan is about to welcome a new governor. Against this backdrop, the dollar-yen pair was fluctuating rapidly throughout the week and closed the session at the opening levels. The nominee for Bank of Japan, Governor Katsuo Ueda, who will replace current chief of the central bank Haruhiko Kuroda, has repeatedly stated his support of the ultra-loose monetary policy. However, at the second parliamentary hearing in the confirmation process, Ueda said the benefits of the Bank of Japan's stimulus outweigh the side effects in the current economic scenario. He also added that monetary tightening would be necessary only if inflation rose considerably. These signals suggest that the Japanese central bank may consider changes. For your reference, inflation in Japan jumped to 4.3% in February, while the core inflation index continues to rise and has been holding above the key target for 9 months in a row. Gold managed to stay in positive territory last week and gained 2.38% to reach $1,850 per troy ounce. The yellow metal took advantage of a weaker US dollar, which started to ease after dovish comments by Raphael Bostic that we have mentioned above. Gold is very sensitive to interest rates, as higher rates make it more expensive to hold gold as an asset. Oil traders also closed the previous week with gains. Brent crude advanced by 3% after a rapid drop, which came as the Wall Street Journal reported a growing rift between the two largest OPEC producers, Saudi Arabia and the United Arab Emirates. This news raised concern over possible disruption in the work of the cartel and the increase in crude supplies. Yet, by the end of the week, the United Arab Emirates denied what was said by the American media. Apparently, this could be another attempt by the US to aggravate the situation to its advantage. Earlier, Russia, a member of the OPEC Plus energy deal, announced its plans to reduce oil exports by 25% in March in response to sanctions imposed by Western countries under pressure from the United States due to the conflict in Ukraine. This means that Russia will exceed its plan to limit production to 500,000 barrels per day. In addition, investors expect China to import a record amount of crude oil in 2023 amid increased demand for fuel and launch of new refineries. So, as recession fears wears off, oil resumes its upward movement. These are the trends of the last trading week. Do not miss our daily news report to be always in touch with the latest events. Stay tuned and see you soon.